Hey, what's going on, everybody? My name's Andy. My channel's Finding Value. If you like making money, subscribe to the channel. I like making money too. Thumbs up for the content. Today, I'm going to go over previous commodity bull markets. Got a lot of new subscribers. I want to make sure that everyone understands the potentials that we have on the plate in our coalition portfolios. Coalition is a group of cheetahs, and to see, what the possibilities are. So let's jump into previous bull markets so you guys can see what those bull markets had returned. So from 2000 to 2008, the bull market returns. We've got the price returns of the actual commodities on the left-hand side. So gold was a 7.3x, silver about 11x, platinum 6.3, uranium 15x, that's pretty big. Oil was a 10x, and nat gas was a 9x. The company returns on the right-hand side. So AUY, 71 times its money. This is a precious metals company, a gold producer, Yamana Gold. AEM's kind of a silver gold producer, 13.9. Paladin is a uranium producer. That's 1,300 times your money. Contango Oil and Gas, 920 times your money. SM Energy was a 20x. Devon was a 9.8x. And COP was a 5x. Now, one thing I want you to focus on, you would have been better off buying oil itself than you would have been buying ConocoPhillips or Devon Energy. So what I do in my portfolio is I really focus on the small cap producers of oil, precious metals, the mining companies, and then I try to find some diversified miners that can kill it. So that's kind of what I have in my portfolio are the small cap type companies where short sellers maybe tried to drive them into the ground and almost try to kill the company or bankrupt them. So I kind of buy some of those higher risk companies. I spread the money out. I really do we'll call it a small allocation to each company. Maybe it's a few percent of the entire portfolio, like 2-3%. If I have a lot of knowledge of a company, I may up it a little bit, but that's what I really go after. In 68 to 1980 bull market, that was the commodity bull run. The price returns for gold were 21x, silver was 37x, platinum was a 10x, and oil was a 13.7x. The company returns, when I was looking at them, many of them were between 10 and 40 times their original amounts. That was in oil and gas, uranium, and precious metals. And they did a lot of these moves in only a 2-year period from 78 to 1980. So the one thing that I want you to take away from this is some of these moves are very rapid and they're very strong, and they usually happen at the end of the bull market. We're like at the beginning of the bull market, sitting at 100-year lows, and we're already seeing some pretty good moves that maybe some people have never seen before. So what I want you to think of is you got to think of the end moves. The end moves is what I saw last bull market in 2008, and it was spectacular. So both of those bull markets had absolute blow off tops at the end of the market. And that's when it's going to be the most difficult to hold on, because I'm envisioning by the time we get to the end of this commodity bull market, we may be up already 10 or 20 times your money. And then you could do another 10 or 20 times your money the last 2 or 3 years of the bull market. So it's very important to hold on and to understand value and market conditions, because if the value is good and the market conditions are still good, there's no reason to sell. You got to hold on, and you're going to see your portfolios grow quite rapidly with very large sums of money that you're probably not used to seeing. And I just put notes in here. Peak oil in the United States happened in 1970, and the housing boom happened in 1970s, just like we have a housing boom coming right now. The current bull market, 2020, that's my guess. I see similarities between 1970 and today with demographics and the housing deficits. So we have a housing deficit of homes that will drive massive inflation, just like the 1970s. We've got a lot of money printing going on, just like the 1970s, and the demographics are very similar. So on the right-hand side, we've got massive deficits of many of the base metals in uranium production. The deficits are the supply-demand imbalances, which creates a deficit. So we have massive deficits everywhere of metals and uranium. We've got peak gold, which is projected. Peak gold is the peak mining of it. The supply side is about to peak anytime now. We've got peak silver soon, peak mining of it. We've got peak platinum production potentially out a little bit. We've got massive debasement and green energy ramp up, which is going to use a lot of the minerals that I just talked about, just now in terms of silver, platinum, and a lot of the base metals. And we could potentially hit peak oil from a supply side worldwide sometime this decade, like 2030, 2027, 2032, somewhere in that range. That's where a lot of the estimates are currently. And I just wanted to show this. This is the housing starts. These are the commodity booms. This is the start and end, start and end, start, and then we don't know what the end is. Hopefully we see one that just has a nice big ramp up like this over time, and then we'll see our housing metrics get all jacked up at the top. So that's what I'm projecting going forward. This is also showing the commodity to S&P 500 ratio. We are super cheap right now in relationship to history. So it's a great time to be investing in commodities. This is the South African platinum output in gradual decline. This was in the mid 2000s. It's been declining ever since. This is the platinum production of South Africa. South Africa produces 80% of the platinum in the world. So we have yet to see this reverse and move to the upside. We've got gold supply. I think this one's from Barrick. They have a peak in 2020 and then a decline after that. So we're at peak we're at peak gold, peak supply possibly, and then we'll see a decline in gold supply over time. This is going to be massively bullish for gold when we're in a commodity boom at the same time that supply is peaking. So this is pretty crazy to know this information and to make educated investment decisions into precious metals at the beginning of a commodity boom with supply potentially declining over time. And this is mine production from silver companies. It is also in decline. We've basically just recently from the silver squeeze wiped out all of the investment silver on probably in the nation almost from bullion dealers and online dealers. So silver, I think, is going to be a very good investment going forward. Silver, gold, platinum, all the precious metals, I think will do exceptionally well. And this is the world production for silver. They've got the production peak being like 2025, somewhere in that range. So we're coming up on peak production of silver. That's what's projected. So we'll see if that holds true. We've got born in 2010. How much is left for me? Here's silver. They're saying that 2030 something that's about all you've got. That's it. Here's gold, about the same thing. Zinc is down there too. Oil obviously extends out, and gas and uranium's out there a lot further into the future. So my opinion, these are all long-term holds. Are the metals finally hitting peak production? Are we going to have chronic shortages from this point on in palladium and rhodium? Potentially. And if there are chronic shortages of those two metals, I think that's going to help out platinum extensively because platinum is a substitute metal. And I think soon to be peak production could potentially be silver, gold, and platinum in the next 10 years or less. This would be evidence to hold physical precious metals as these become more rare and harder to get. Harder to get means that you're going to have to expend many more units of energy to get these out of the ground. And if energy becomes scarce, holy crap, these are going to go up in price. So this is just more evidence, I think, to hold physical precious metals and not the paper markets. And if we do hit an energy constraint, what you're going to see is all the markets, because since they all price future projections of cash flows, would really tank the market if we ever had a problem with energy. Now, this is physical versus companies. The physical is on the left-hand side, no business risk, no tax risk, no nationalization risk. It's really no risk of anything. And the companies, even though you can leverage the returns of the price moves if you're in a company, you can speculate in the small cap companies to get massive leverage, but there's problems with that. You can choose the wrong company. A company can go bankrupt at a bottom. Usually you allocate small amounts of capital to many companies. That's my strategy for allocation. You might have trouble extracting minerals. That could be a risk. And then you could have energy price problems, which will throw the mining companies into their margins could contract, depending on the compression and expansion of a gold to oil ratio or an oil to whatever that mineral is ratio. So the conclusion here is I think we have a similar setup to the 1970s, which was an inflationary period in terms of demographics and real estate. We've got lots of money printing. They did a lot of money printing in the 60s. And then we also can look at the commodity to S&P 500 ratio, and they're very similar. I think in 1970, we hit peak oil in the United States and became a net importer of oil. And remember, in the 1970s, it was mainly a United States problem. And on the right-hand side, we could be hitting peak oil worldwide at some point. I don't know when, but that would be a major problem. And physical metals might be more valuable compared to companies if we hit a peak oil scenario, because it'd be exponentially harder and exponentially more expensive to get those metals out of the ground versus having it in your possession already. Basically, you have something that everybody wants in the world. This is now worldwide problems. It's not mainly in the United States. Everywhere is doing money printing. Everywhere we're going to be hitting an oil peak. Everywhere we're hitting minerals peak. It's not just local problems. It's a worldwide problem. And I think, at some point they're going to struggle to produce worldwide with nations having issues. And when you think of it, if nations start having problems, they're going to start nationalizing strategic materials. So if you own a bunch of strategic materials, which precious metals, especially silver and platinum, and even gold, could be considered strategic metals for national defense, for whatever reasons they may be, I think it's absolutely a smart idea to hold some physical of just silver and platinum. And then we also have declining ore grades of all the minerals, which requires more energy, which requires more and more time, energy, et cetera, to get these minerals out of the ground. So I want to go over this presentation and make sure everybody understands the game they're in, to give you kind of a big overview of what the expectations are for some of these metals and the potential opportunities for investment if you're looking at it. Platinum and silver, in terms of physical metals, are absolutely just on fire sale, knowing this information if you have a long-term outlook for investments. And then I think oil is another good spot to be in, and uranium, because if you go into energy issues in the future, you kind of want to checkmate that whole area, because one, if oil has a problem, then you're going to go to electricity, and then the baseload energy, nuclear power, is one of the highest energy return on energy invested. That I have other clips on that to basically say, hey, look, this is the highest returning energy that we can use in generating electricity. And if we're going to move all these, I don't know how they're going to do it, move all and get all these minerals out of the ground to build all these electric vehicles and renewable energy, I think that we're going to expend quite copious amounts of oil and diesel and all that stuff to get all those minerals. So I still think it's a checkmate scenario to be in oil. And if everyone starts drawing money from investments from oil, that's just going to reduce the supply. And I think we could see a major move in oil over the next 5 to 10 years, which is this next commodity bull market, with all the inflation pushing, with all of the commodities that need to be mined out of the ground, all the renewables that need to be made. I see it as a very good opportunity. And with the ratio of where it's at today, a 35 to 1, 35 barrels to 1 ounce of gold, typically at peaks of commodity booms, oil is more like it's under 10 to 1, maybe like an 8 to 1, 6 to 1, something like that. Huge opportunity for all these investments. If you guys like this content, give me a thumbs up, leave comments on what you guys think in the comment section. And I appreciate you guys listening. This is Finding Value.